today we're going to talk about the math of money. All right, so some of you may be familiar with some of this stuff, some of you not, but we can we're going to go through it to get everybody on the same page. All right, the first thing that we're going to talk about is the power of compounding. Here's a question to start it off. A lily pad doubles in size every day. After 30 days, it covers the entire pond. On what day does it cover half the pond? 15?
29.
29? Thoughts?
Oh, that's smart. 29.
Oh, you're right. He's right.
Wait, is that smart?
It doubles every day.
So it'd be half of it's 30 at 29.
Yeah, it's 20. It's 29, right? So Chase's answer is the typical answer that people give right away. When you don't think about it that quick, that's the first answer you give. And the whole point of compounding is that most of the action happens at the end. Okay? Most of the that's basically what happens with compounding, right? So the biggest changes happen at the very end when you're compounding, because you're multiplying times a bigger and bigger and bigger sum as you go along. Okay. Does anybody, don't look at that for a second. You don't have to look at that for a second. Right now, I'm just going to ask you this. If you've got $100 and you make 10% interest every year, in 1 year, how much money are you going to have?
100.
Okay. All right. Let's say you earn 10% interest every year. After 2 years, how much money do you have?
121.
No,
110 multiplied by 121.
It's 121.
121.
Does everybody understand why it's 121 and not 120?
Yes.
Yeah.
Okay. It's okay. If you don't understand, this is like, just say so. Like, it's totally cool.
Yeah, it said 121.
All right. Everybody understands that. Okay.
132.
All right. So the way you get is that, hey, yo, no. All right. So if you got 100, the way we did it is we took $100, and what do? We multiplied by 1 plus R. In this case, what was R in the example I just gave?
The percentage.
The percentage, right? It's 10, but not. It's 0.1. In this formula, it's going to be 0.1. And what's N?
The number of years.
Number of years, right? Because we're so in year 1, we go from 100 plus 1 times 1.1. Hey, hold on. Hey, Natalie, is the heat on? Yeah, it's like it feels like the heat's on.
Otto, can you play around with the? You have the access to the thermostat right now.
Yeah, right there. Let's just.
I tried to turn it to cool. You just click the button.
Or we could just turn it off.
Turn it off or something.
Yeah. Right. I mean, off. Faster than no heat. Thank you. Okay.
Oh, you're
So
going at 9ish?
What's that?
9ish?
9. Yeah. So if we so N is the number of years. So the most important thing about this is if you just thought about if you didn't compound, right, and you got 8% for 10 years, and just in your first year, how much interest would you get in that situation? You got $1,000, you earn 8%. How much interest did you make after 1 year? At an 8% rate. So $1,000. What do you have at the end of 1 year? If you earn interest at 8%.
$80. $180.
$80. Okay. So at the end of the first year, you have $1,080. If there were no compounding at all, you would think that after 10 years you would have $1,800, right? Like $80 a year. That's what you would think would happen. But what do you actually have after 10 years? Yeah, $2,159. Because if you follow that, you're going to end up with way more. So compounding is super important, right? Because you're growing at a faster and faster and faster rate. Okay. So the point of it is like the N and the R are what really drive this formula. Why do we care? And this is kind of like, well, this is why we care, actually. This is why you specifically, a room full of high schoolers and middle schoolers, are here right now. Because of this slide. This is something. It's something that's kind of crazy, honestly. Let's say that you earn 8% a year on an investment. Okay. Let's say you have person A. They're 25 years old. They're a couple years out of college. They're making some money. They got a little bit extra money from their job, like say $5,000 a year. They take the $5,000 that they have in savings a year and they invest it. And they're earning 8% every time they invest. So for that, so what they're gonna do is for 10 years, just from age 25 to 35, they put 5,000 away, and every time it's gonna earn 8%. Person B waits until they're 35 years old. And then they're gonna invest $5,000 a year, not for 10 years, for 31 years. Every year for 31 years, they're gonna stick away $5,000. The totally insane thing is by the time they're both 65, person A has ended up with $850,000. Person B has only ended up with $666,000. Person A only invested $50,000 total, right? They put $5,000 in for 10 years. Person B put $5,000 in for 31 years. They put $155,000 in, and they ended up with 105. They ended up with 184,000 less dollars than person A. The only difference is that person A started earlier. Okay, this is a wild figure. Like, there's literally a difference of this person had to stick 31 years of money in, that person did it for 10 years, and they ended up with way more money at the end. Like, I look at this and I'm like, I really wish I had been sticking money, I had been investing money since I was your age, or a little bit, or you guys probably don't have a lot of extra savings, but like 23, 24 years old, I wish I was putting money away, because I have a lot of money, okay? So, super important. And this is like, makes no sense. This is like the Chase thing. It's like, you throw out the number 15 because you're like, oh, I think it's probably pretty close. Maybe person B, they put in so much more, you think they're winning. They get slaughtered by person A, okay? So it's very hard to imagine unless you look at that math, right? So some of you may have heard of Warren Buffett. He's known as like maybe the greatest investor ever. Crazy thing about him, he's worth something like $130 billion. 99% of his money was earned after the age of 99% of that net worth came after the age of 50. It's because he started investing at 11 years old. All right, so he was just investing. This dude's secret is he's been investing basically forever, and he became super rich doing this. It is almost impossible for you to not end up super rich if you start investing now. Like if you can make money, set it aside, and invest it, and it grows, it is almost impossible that you will not be rich. That's how powerful this is. That's why we're here. That's why we're talking about this. For the same reason that I wish somebody told me this when I was your age. Okay? So this is just a chart, like it's kind of showing you some pretty crazy stuff. Like, this shows you the power of if you get a higher rate, and then the power if you get a higher rate. This is only a 2% difference between 7% a year and 9% a year is only 2% difference a year. But over 50 years, you end up with almost 3 times as much money here, right? And the other thing you notice is, the difference between 10 years and 30 years is three times, right? 3 times as many years. But these numbers are way bigger than 3 times more, right? 3 times that would be $60-something thousand. You end up with 6 times that, not 3 times that, even though it's only 3 times as much time. So again, it's the power of compounding. I'm just trying to drive the message home that most people do not understand how powerful this math is, but they don't understand it like you could be guaranteed to be rich when you're older if you understand this. That's all. All right. This is just, we talked before, like we did that example where after 2 years, if you invest at 10% a year, you go from $100, 10% a year. After 2 years, you end up with 121. That's the first one. That's called total return. You can think of it as that's the result. That's the end. That's the destination, right? So I have 121 after 2 years. If you want to think backwards, right? Normally, let's say you have $100, and after 10 years you end up with $1,000. Okay. you end up with $1,000. How much do you think you made per year? If you started with 100, you ended with 1,000. After 10 years, what return did you get per year? Can anybody take a guess?
200.
How much did you earn per year, percent-wise? What was your average return per year to end up with $1,000 at the end of 10 years? Let me do it this way. Let's say, what it to end up with $200. You start at $100, you end up at $200 over 10 years. What is the average amount you had to make a year to end up like that?
10%.
The 10% is the answer that you would think, right? So again, but it's not the answer that takes in, because what you did there is you basically averaged it, right? You divided it by the number of years. But the point is that you have to take, it's not a simple average because you're multiplying every year. You're multiplying 100 times 1 plus some rate every year for each one of the years to end up at 110. The actual formula is instead of dividing by 10, which we do with averages, you take the 10th root. So you would say, what's my destination? 200. 200, the 10th root. What's a 10th root? What's a square root? Anybody know what a square root is? It's raising something to what's power?
Itself.
2.
1/2. 1/2. The square root is raising to the power of 1/2. All you're doing with the 10th root is raising something to the power of 1/10. So if you just stick in a calculator, 200. Anybody has a calculator, you hit 200, raise it to the power of 1/10 or 0.1. 200 to the 0.1 power. Can anybody do that?
I think Kian can.
1.698.
Yeah, 1.6. It's actually 1.6986.
1.6986.
4 6 repeated.
Yeah.
200 to the 10th power.
And then
You guys
6
stop.
for your
And then the
200 to the 1. Oh, yeah,
200 to the. So you know what? I made. Sorry. I made a mistake. It's let's say you had $1 and it doubled. It's the same thing. We started 100 to 200. If you have $1 and it doubles, let's say 2 to the 1/10 power. What do you get? Because you doubled, your money doubled.
4.
To the 1/10, 2 to the 1/10 power. You have to use a calculator. You can't do it. It's like, what is it?
1.071773.
Right. And now, so just subtract 1 from it, because that's the money you started with. And what do you end up with?
3.
0.07. That's 7%. The answer to I doubled my money in 10 years is I had to have earned 7% a year, not 10% per year. Right? If you earned 10% per year, you would have ended up with way more than 2x. 7% per year would have gotten you to 2x. So that's just kind of the math of compounding. This is a neat trick. If you take 72, this is called the rule of 72. If you take the number 72 and you divide it by an interest rate, so 72 divided by, and you can just ignore the percent sign. If you take 72 and divided it by 10, you get 7.2, right? That's how many years it would take you to double your money. So if you take 72 and divide it by any interest rate, that's how long it will take for your money to double. So if you earn 12% a year, your money is going to double in 6 years, starting from right now. If you only earn 6% a year, it'll take you 12 years for your money to double. So that's a kind of a handy trick. 72 divided by the interest rate, and that's how many years for your money to double, because we all want our money to double.
Can you do that? Is it just 72 or is it, can you do that with any number?
No, 72. I'm not going to derive why it's 72, but it's literally just called the rule of 72. You just remember 72 divided by the rate. Also, it's hard to read it there, but it says if you take 72 and divide it by the number of years you want your money to double in. So let's say you want your money to double in 5 years. What's 72 divided by 5? If we do that.
14 or
So 72 divided by 10 times 2, right? You do it fast, okay? So 14.4. So if you earned at 14.4% per year, your money would double in only 5 years. So pretty powerful. Okay. All right. So first class, we looked at everything from the perspective of a business owner. So you own a business. You raise money. So you either borrowed money or you sold a percentage of your company in order to get funding so that you could fund your business, right? We took everything from the lens of the business owner, the lemonade stand owner. In our case, we used the La Miranda sneaker company, right? Here, we're going to flip it. And we're going to look at things from the perspective of the investor, the person who gives the business owner money and says, I'm going to give you this because I think you're going to make more money for me and you're going to give me money back. We're going to look at it from your perspective, the investor's perspective. Someone asks, someone's asking you for money and you say, what are you going to give me back, okay? I want to remember, let's go back and we're going to remember La Miranda Sneaker Company, what happened with that. So La Miranda Sneaker Company was making $15,000 a year of income, okay? There was 1,500 shares of the company outstanding, right? So, do you guys remember what EPS is? That's how much money per share that La Miranda Sneaker Company is making. So the company makes $10 a share, okay? We had 7 locations, and we thought it was run by some smart people, and they're out there on TikTok doing marketing, and we expected its earnings are going to grow at 20% per year. Okay, they're going to sell 20% more sneakers every year. So we got $10 per share is how much it earns right now. Now they come to you and they say we want to raise money. We need money to grow. And you say, that sounds like a pretty good idea. I think you guys know what you're doing. I'm going to give you money, and I'm trying to make some money on this, and I'm going to plan to hold this investment for 5 years. Okay, I'm going to hold the investment for 5 years. All right, this is where you open your Google Sheet. Okay. I'm going to remind you that the company makes $10 a share. And you know what? What you're going to do is you're going to go to your tab and you're going to put in how much money you wouldn't pay for a share of this stock, knowing that right now it makes $10 a share and you think its earnings, they're telling you, they're trying to pitch you, like, give me money, our earnings are going to grow 20% per year. How much would you pay for a share of something that pays $10 a share? Okay. If they ask for a loan instead, let's say they ask for a loan, what interest rate would you need to lend them money at? You would be willing to lend them money. What's the lowest interest rate you'd be willing to offer them for the loan? Okay. So 2 questions. Let me show you real quick on the sheet. Hold on, you got. Ezra, can you see it on your phone or no?
Yeah.
You can? Okay. And Isaac, do you have a computer? I can't see.
Yeah.
Okay, alright. So everybody, okay. So, does everybody see just the 2 cells on their tab at the top that says how much did you pay for a share and what the interest rate is?
Can Milo do it together because his iPad doesn't.
Yeah. Let me make sure that, yeah, it's just those 2 cells that are the lowest interest rate. You guys see where you're at? So everybody, does anybody need help?
Because I'm gonna make
Yes.
Yeah.
confused on
Gotcha.
Yeah, I just put it.
Okay, go to your tab.
Wait, what did you put for
So the first, it's just 2 cells you're filling out. How much do you pay for a share of stock?
the lowest interest rate? So on the lowest.
What's that? What's the cost?
Accept.
What's the cost of the company?
Alright, so the company, all you know is the company makes $10 a share.
All the
It makes $10 a share.
$10 cost.
Yeah. Yeah. It makes $10 profit per share. Okay? It makes $10 profit per share. So I'll just say something just to like help you guys if you're stuck in any way. But like, if you think about if somebody said to you, hey, if the bank, what does the bank do, right? The bank says to you, hey, you give me $100 and we'll give you $4 a year. And whenever you want your $100 back, we'll give you your $100 back. But they're basically willing to give you $4 a year if you give them $100. So you're kind of thinking about it like this way, like, hey, well, somebody's gonna give me $10 a year. How much would I be willing to give? How much would I be willing to pay to get $10 a year from somebody? The bank is willing to pay you $100 a year. I mean, $4 a year to get your 100. Or the other way of putting it is like, you're willing to give the bank $100 to only get $4 every year, right? Here I'm telling you, I'm gonna give you $10 every year. How much would you pay for that? Right, so just to help you in case you're stuck. Once, okay, then while you all doing that, let me go here. So this is going to be who I'm waiting on. Jason, what's up, bud?
How long are we supposed to be, or are we just gonna, how long are we holding the shares?
5 years.
So wait. If each year makes $10 per year, I make 50. Oh, wait. So I'm paying more than $16.
Oh, don't type in these cells. Don't type in these cells, please. Undo. Control Z, whatever. Alright. We're waiting on, yeah.
Can you explain that interest rate one more time?
What's the lowest amount you would accept to lend them money? Right?
What's like the regular
What's that?
Like what would be a regular number?
Is that McDonald's?
15.
Oh, like, think of it as with the bank, you're willing to lend the bank at like, if you put money in the bank, you get something like 3%, let's say, 4%, somewhere in that ballpark. So you're willing to give a bank money for only 3 or 4% back. But a bank is like, do you think a bank is probably going to give you your money back or no?
Probably.
Probably.
So wait, it should be lower?
So it feels it doesn't feel very risky to give money to a bank. If you give money to me, because I'm running a sneaker company, does that feel as safe as a bank to you?
Nope.
No.
No, so you probably want to get paid more than what you would accept from a bank, right? Does that make sense?
So higher. Higher percent.
I mean, if you want to lend me money for at 1%, I'll take it.
I'm lending you to 10%.
Alright, so Milo, I know we don't have to wait on you because that you're working together, and then I'm just waiting on Isaac.
Oh, I'm working with them.
Okay, alright, so, good, everyone's ready. Alright, so, alright, so everybody put it in. Now, let's see what happened here. I'm going to have to walk, one sec. Alright, so, first of all, I'm curious to see right now what you guys put. What all you put. So Zoe was willing to pay $100. Is that the low? That's the, no, or that's the high, right? That's the maximum bid. The maximum bid was $100. Zoe was willing to pay $100 a share. The minimum bid was $1. Who did that? Julia only want to pay $1. Okay? So we have a rate. We have a market. Some of you would pay $1 for this right. Some of you would pay $100 for this right. So we have 100% disagreement on like what we think this could be worth. Okay. All right. How about? So what I did here is we compute the minimum, we compute the maximum. Who knows what a median is? It's the middle value, right? The median value, anybody was willing. middle value is $20. So paying $20 to be for the right to make $10 a year. Okay? And then the 75th percentile would be like sort of, you can think about that as like halfway between the middle person and the top person, right? The 75th percentile person is willing to pay a 24 and a quarter, okay, for shares. All right. Before I go to the next thing here, what I want to ask you is this: if you pay $100 for this, like Zoe's offered to pay for this, and you earn $10 a year, what is the return that you're getting a year? You spend $100 and you're gonna get $10 back.
10%.
10%. Somebody might think, now I want to just be clear about something. You're not losing 90% because you're giving $100 and then you're getting $10 back. Because in 1 year, if the company is still doing what it's doing, it's still worth $100, right? So you've got $100 in 1 year. You have two assets, right? You have a company that's worth $100 and you have $10 in your pocket because they gave you $10 of their profits, right? Yes. So that's exactly right. It's 10% profit. Now, if you pay $1, actually, $1 is kind of crazy. let's pick $20. Ezra says he'll pay $20 for this company. So Ezra, what's your return going to be if you pay $20 for it? So you pay $20 and then in a year you're going to get $10 back. 50. Who can explain why it's 50? I want to hear. Go ahead.
Because $10 is half.
Right. And at the end of 1 year, what do you have? Today you had $20. At the end of 1 year, you have a $20 company. Still have that, and now you have $10 of profit that you put in your pocket. Right. So you have $30 of value on $20 of initial investment. That's a 50% return, right? Okay. So I'm pointing this out because every one of your bids has something that we call first of all, what's this implied PE is like a horrible term. I should have changed this, but I should call it multiple. It's just how much you're willing to pay for the $10. So Zoe was willing to pay 10 times the earnings for the stock. She was willing to pay 10 times the earnings for the stock. This is Maddox was willing to pay 3 times the earnings for the stock. This is a very important number. This PE, this what we call PE or multiple. It's how much you're willing to pay for that share, for that earnings. Okay. Earnings yield is just flipping that fraction. If you just take the reciprocal, you all know what a reciprocal is? If you just flip these numbers, take the reciprocal, you just get an earnings yield, right? So we flip that one, that turns into 1/2. That's where we get the 50% earnings yield. Y'all, I don't know who's doing that, but please don't type things in here.
Wasn't me. I swear.
Okay, all right. Whoever it is, just don't do it. So these earnings yield are flipping the multiples over. That is the number. That is the number that you can think of as like, how do I compare? Is this something a good investment versus how much I could earn doing something else, right? Like the bank will pay me 5%, but these earnings yield, look what these numbers are like. They're way higher than 5%. You're gonna make way more money if you can buy this company for some of these earnings yields, right? This is way better. Okay. The loan rates that people are willing to now compare that. Like look at the loan rates people are willing to lend money at, and how much money how much earnings yield you would want. So let's take one like this one. I'm gonna take Shane's. Okay. Shane is willing to lend La Miranda Sneaker at 8%, but in order to buy La Miranda Sneaker shares, he's looking for an earnings yield of like 45% a year. But you'd be willing to lend them money at 8% a year. What could explain that difference? Who can remember the different risk reward? Go ahead, Julie.
Because if you loan it, then like they give it back no matter what, and only if they like do really bad at
then they might be like dishonest and not give it back to you. But if it's, yeah.
Hey guys, don't do it. Yo,
It's not legal stuff.
Julia's speaking, so, sorry, Julia, so you were saying, so they're lending money at, if you lend them money, you pretty much think you're gonna get it back, right? So you're willing to accept a lesser amount. What don't you get when you lend somebody money? Like, what's the part that's not so fun about lending somebody money?
You might not trust me.
Yeah, okay. Let's say they're gonna give you the money back. There's still a drawback, Daniel.
If the company does really, really well, you're still getting like the same payments.
I said that.
Yeah, that's right. Right, that's the big thing. So it's like, it's almost like when you lend somebody money, what you're concerned about is what's my worst case scenario. When you buy shares in the company, you're thinking about the upside. You're like, I'm thinking about how good can this be, right? It's a totally different mindset, right? To lend money versus to buy shares in the company, right? So you can see here, for the most part, your instincts are pretty correct here. Like, you'll lend at a lower rate for the most part versus how much earnings yield you expect. You expect to, if you're gonna give somebody, buy shares in the company and not have any chance, not have any guarantee you're gonna get your money back, you better get a good return. And this is what your bids are reflecting, that need to get a really good return. Okay, so now I wanna talk about, so what I'm gonna do really quick here is, I'm gonna do it over here. Cause I wanna talk about the math of the 5 years, right? So, like, let's say you buy the company. What I'm gonna do is Zoe's bid for this, okay? So Zoe said she's willing to pay 10x, right? I'm gonna just write multiple here, okay? Zoe was willing to pay 10 times the earnings, right? Now, in 1 year, how much did they say this company's gonna grow?
20%.
20%, okay. Now, actually, you know what, Zoe, I'm gonna apologize to you. What I'm gonna do here is I'm actually gonna use, I think I'm gonna use Ezra's bid. So, no, I'm gonna use Maddox. Maddox, you're using you, alright? Maddox is willing to pay, Maddox, what were you willing to pay? How much?
$30.
You were paying, right, so you're willing to pay a multiple of 3, right?
Yes.
Okay, good. Now, the company's earnings in the first year were $10. All right. So the share price was equals. All right. All right. If the earnings grow 20% this year, okay, and the share price and the multiple doesn't change, meaning that somebody is still willing to pay 3 times as much for the company's earnings in a year, where's the stock price go?
Up.
Where? What price?
30. Oh, shoot.
All right, who's gonna figure this out? Earnings have grown 20%, and the multiple is 3. So 36. Does anybody agree, disagree? Hunter, what do you think?
I agree.
You agree? 36, right? How did we get 36? How did we get 36? What, hey guys, you guys can listen up. Back there, Tyler, why is it 36? Alright, well, let's see. Daniel, how is it 36?
Because it was.
Liam, Liam, why is it 36?
Uh,
The shares started at 30, and we're hearing that it's 36 now. Why?
it went up 20%.
What went up 20%?
Oh, wait.
The stock did go up 20%. It did. That's what 36 implies, that it went up 20%. But why is it up to 20%?
The multiples.
You're on the right track. How well did it do?
20% better.
20% better.
But what did it used to make?
30.
30, and then 20%.
Did it used to make 30?
Used to make 10.
Used to make 10. How does it make? What does it make now?
12.
12.
And then times
times
3.
And then you're willing to pay 3, 36. Now, okay, that's pretty cool. Like, the earnings went up 20%. If you're willing to pay 3, a multiple of 3, now the stock price is 36. Here, okay. All of a sudden, Zoe comes running into the room and says, I'll pay 10 times the earnings. Where's the stock price?
120.
120.
Yeah, 120.
120. How much return did you make when you bought that stock for 30 and it's now 120?
400.
4x. 4x. 4x, by the way, is how many percent increase?
400.
Almost.
300.
300. Think of it this way. If you make 100% on your money, what happened to your money?
Double.
It doubled. So 2x, 100%. 3x, 200%. You have to. It's off by one. It's off by one, right? So this stock, 4x, if it grows its earnings by 20%, and then Zoe comes running into the room saying, I'm willing to pay 10x the earnings, you end up making 4 times your money on this, which is insane. Why would somebody possibly come in and offer 10 times the earnings for this company, even though the earnings are only up 20%? Why might somebody do that?
To see a future.
In future.
That's right.
They can see the
They have looked at this and said, you know what? This company's earnings just grew 20%, but I think this company's earnings are going to grow way faster. So the question is if you thought a company's earnings is going to grow way faster than 20%, would you pay more for the earnings or less for the earnings? More. You pay more. Here's another question. In this case, the earnings went up 20%, and before we paid a multiple of 3. But you know what? Liam was a very conservative investor. He was only willing to pay 2x for earnings. Let's do the same thing. You have $10 of earnings. It goes up 20%. But now, Zoe's nowhere to be found. Liam is the only bid in town. Huh? That's weird because this is it's kind of weird.
How can people do this?
I don't know how that happened because it's supposed to come off of this. Isaac, do you have it back up again?
Drop it again. It'll get loud.
That was weird.
Just drop it again. Drop it again.
No, don't drop it again.
Yes,
Let me
drop
try
it
it.
again.
Sometimes you're gonna like punch the. Are you the one?
Oh, come on.
No.
I'm not. I did
For
what?
a gun?
Whatever it is, it's called.
Okay. So the earnings are what now? They went up 20%. What are they?
They went up from.
They were $10. We're starting again.
So
Earnings are what? Earnings are 12. Zoe's off on vacation. She doesn't see the stock. Liam is the only person bidding for the stock. He's willing to pay 2x. Where's the stock price? 24. You invested $30. What is your return if the stock is now 24? And what is that in return?
Negative 20%.
Negative 20%. It's negative. You just lost 20% of your money, right? You could have, if you lent money, you would have earned money either way, right? Because even if the multiple fell, here's what's happened. Why does the multiple fall? Why could it fall? Why did it possibly go from 3 to 2? Who can understand why it could go from 3 to 2? Go ahead, right here.
Because it's the price of the original price of the share divided by the earnings.
Right, but what happened here was we used to have somebody that was willing to pay 3 times the earnings, but now the best bid is somebody willing to pay 2 times the earnings, right? Why would somebody no longer be willing to pay 3 times the earnings and they only would pay 2 times the earnings?
Because it's not doing
If
well.
they didn't see future.
Exactly right. The opposite situation. This is, hey, I want you to recognize in both situations, the company earned what it said it was going to earn. But the outcome is completely different. Because what determines the value of a stock, not just what happens right now to the earnings. Right, but it's the prospect of what is going to happen. It is the future. It is the future, right? So I don't have a chart of it right now. I'll show it to you later. But if you look at a chart, what during COVID, because you're all so little during COVID, what company skyrocketed during COVID? Zoom.
I said first.
Here's the crazy thing about Zoom. Zoom's actually let's pull it up.
I was gonna be like YouTube.
Zoom stock price. So Zoom stock price.
Down. It's up. It's up.
This is
You got it right down. Oh, it is down.
that's Zoom stock price over the last 5 years. But I'm going to tell you something. Their earnings.
76%.
Their earnings, this company's earnings, have fulfilled what people thought was going to happen. They went up every year. Their earnings have skyrocketed over the last 5 years, as you would expect. And yet what happened?
It went down.
You lost money. Why?
No one uses Zoom after COVID.
I just said their earnings have skyrocketed over the last 5 years. It's completely false. They have earned a lot of money.
Oh shit.
Shane.
Because like people have like lost confidence in Zoom.
Potentially, that's a potential reason. Daniel.
Well, during COVID, everybody had to use Zoom to communicate, but then when it finished, people had to stop using it and could go back to office and school. So a lot less people started using it.
That's true, but their earnings have exploded in the last 5 years. That wouldn't, if that was the situation, their earnings wouldn't have exploded. Tyler.
Because the investors wanted to invest in Zoom because they saw the potential in Zoom over COVID with everybody going on calls. But now the investors don't want to invest and the stock price goes down because the stock price is just what the investors want to pay.
And specifically, what number collapsed that made the price go down that we've been talking about? The difference between Liam and Zoe.
Just share.
The multiple.
Oh.
What happened was people paid an insane multiple for those earnings in 2020, 2021. Rightfully so, expecting that the earnings were going to increase. And they were right. The earnings did skyrocket. And what happened is they paid too much for the earnings. They paid too much for them. So they were super optimistic. A great scenario happened. It just turned out that the price that they were willing to pay was too optimistic, even more so than the greatness that actually happened. So this, by the way, is why investing is hard, because the prices are what balance the possibility versus what you see in front of you. So you can see that a company is going to do great, and yet you can pay too much for it. Okay, so let's go back to, I want to go back to this just because I want to show you the scenarios. There's two levers that we've been moving, right? We can talk about, in this case, what I did here is I'm using the median bid, right? Which was somebody that was willing to pay 2 times the earnings, right? $20 a share. This is for somebody willing to pay $2 a share. In 5 years, there's 2 different scenarios that are happening with the investment. There's what happens to the company's earnings. That is the number that we throw the multiple on, right? But then there's also, what's the multiple going to be? How are people's temperature going to be on this stock? Are they going to become more optimistic or less optimistic? So this line right here, this is the base value, right? 20% a year growth, okay? Now, if it grows at 20% a year and the multiple stays the same, you're going to earn 66% per year, okay? What about if you're growing at 20% a year on your earnings, but the multiple slows to only 5 times because people don't want to pay as much for the same earnings? You're only going to earn 44% a year. Now we have the crazy scenario where somebody says, I'll pay 50 times the earnings. Okay? You're going to make 128% per year. Compound that. 6,121%. Okay? That's roughly 60 times your money. You put $100 in. What's 60 times your money on $100 bucks? 6,000 bucks. Some of you might even have $100 bucks right now. And if that happened, you'd have 6,000 bucks in 5 years. Okay? So that is a scenario where the company grew the same as you thought it would grow. It's just that somebody all of a sudden was willing to pay 50 times the earnings because they thought that from that 5-year point forward, this company's business was going to be amazing. That's what they thought, right? So they might be willing to pay 50 times the earnings for that. So this matrix here is really balancing your levers. What happens if the earnings go up, and what happens if people's temperature on the stock goes up or down. Down here, I'm just trying to demonstrate that if you pay more for the stock, all your returns will be worse, right? Because if you pay more, then for the same amount of growth, your return is going to be less, right? You paid more for it, so your return will be worse, right? So this is kind of going off of again, median bid, but this is really important. The 2 levers. It's not just, we don't want to be in this mindset of I like this company. It's not just I like this company and I think they're going to do great. It's am I paying the right price for this company? That's the harder question. Okay, so we'll go back here to the we'll continue from there. So we did that exercise here, and so the price is the balancer between the risk and the reward, right? We talked about this. Those earnings yield, like I said, they're really important because you just flip things into an earnings yield. You take the multiple and take the reciprocal of the multiple. That's all you do. And now you can compare it to other possible investments. I can buy treasury bonds, which is kind of like giving money to the bank for interest. I can earn 4% a year, 5% a year. Real quick, if I earn 5% a year, how long does it take me to double my money?
15.
And how'd you get that?
I remember 6 years was 12 and 8 years was 9, so I had 3 more.
Yep. So you could use the rule of 72. 72 divided by 5% is 75 divided by 5 is 15. So you're right in that ballpark there. So 5% a year. So if you stick your money in the bank, 5% a year, it's gonna take you 15 years to double your money. Okay. But you have this opportunity to buy stocks, which might give you a higher return, but sometimes you're gonna be paying these big multiples. Only 2% earnings yield, right? If you pay a multiple of 50, 1 over 50 is 2%. So you're paying a lot. What's up?
Wait, what do I do with the reciprocal again?
So you take the multiple and you flip it. If you take the multiple and flip it, that will give you the earnings yield, which is something that now you have a return that you can compare to other investments. Because the whole thing is like, how do I know? How is this better than that? You know, how do I compare things? You know, you got a couple kids at school both coming to you and saying, hey, I'll give you, you know, would you pay what we do last time, right? Like somebody's got a business selling potato chips in school or whatever, right? And they say, hey, I need money to buy more potato chips, like inventory. I'll sell you part of my company for 10 times my earnings. And you would say, is that a good deal for me? I don't know if it's a good deal. Well, what's the reciprocal of 10? 10%, 1/10, right? So I can earn 10% a year if I give them money. Maybe you say to them, hey, you know what? I won't pay you 10 times your earnings. I'll pay you 5 times your earnings instead. How about that? I'll pay you 5 times your earnings, and then I'll back your company. And then they think about it and say, okay, that seems okay. If you pay 5 times your earnings, what is the annual return you're going to get on that? If you pay 5 times earnings.
400%.
Come on, guys. You pay 5 times earnings. What's your return? Annual return. I'm gonna cold call someone. Who's gonna get called? Kean. Kean, I pay 5 times earnings for the company. What is my annual return? What's my earnings yield?
I don't know.
Okay. If I pay 5 times earnings for something, let's just say that would be like paying $5 for something that's going to give me $1, right, in a year, right? Does that make sense?
Yeah.
Okay. So then, what is my return? I pay $5. In 1 year, I get $1. I still have this thing worth $5.
20%. Yeah, 20%.
20%. How do we get? And how's the quick way to get to the 20%?
Just multiply it by 2 and then just multiply both by 2.
Right, but if we have a multiple, what's the quick one? What's the fastest way to go from a multiple to the return?
Reciprocal.
Reciprocal. What's everybody do 5 over 1 and flip that? So 20%, right? So now this kid at school says, you tell him, you know what? I'm not going to pay 10 times your earnings. I'll pay 5 times your earnings. They agree. You shake hands. Bang! You're now making 20% a year. How long does it take you to double your money? 3 years. 20%. So 3 years. You invest in this person's company. In 3 years, you doubled your money. If 20%, roughly, right? 72 divided by 20. It's a little more than 3 years.
3.6 years.
3.6 years. Okay. So that's the point. That's why we're doing flip the multiple. We get to a yield, and now we can talk about. Now we understand how much money that means for us in a few years, just a few years. Okay. All right. But why would anyone buy a stock whose earnings yield is lower than the risk-free bond? So why would anybody pay a multiple like 50 where the yield is only 2%? Why would anybody do that? You can earn 4% in the bank.
Because they believe in the company.
They think it's going to grow. They think that earnings number is going to grow. So they're saying, yeah, I know it only pays me 2% now, but if it grows at 50% a year, it's going to be a bargain to buy this company for 50 times the earnings. Okay. This is an example of that. That's Chipotle on the left. This is Shake Shack. Chipotle's multiple, the stock price, trades at 33 times its earnings. Okay? Does everybody understand how we got to an earnings yield of 3%?
Yep.
The multiple's 33, right? 1 over 33 is 3%. Shake Shack. Why Shake Shack? Why are people willing to pay 3 times as much almost for a Shake Shack earnings instead of Chipotle?
I think that Shake Shack's gonna do well in the future.
That's it. People believe Shake Shack is going to grow faster
They're wrong.
than Chipotle. They're wrong. They haven't been to Lafayette. So that's the idea here. Okay. PE guessing game. Now you can go back to your tab. Put in your guesses. Oh, sorry. A PE is a multiple. It's a multiple. How much more you're willing to pay for a share of earnings?
So what we think people are paying?
No, just what you think. Oh, yes, what you think people, investors in the market are paying. Like what you think people in the real world are paying as a multiple for these companies' earnings.
Like times two or like half
Like the Liam versus Zoe example. He was willing to pay 2 times earnings. Zoe was willing to pay 10 times earnings. Chipotle, we saw 33 times earnings. Shake Shack, 93 times earnings, right? 93 times. Okay.
So wait, what do you do if you think it's gonna have like negative earnings? Yeah, can I put a negative earning?
So negative earnings is interesting because it's basically infinite, right? It's like infinite earnings. So if you think it's I'll tell you what. Just for the heck of it, if you think it's infinite, put 1,000. I don't. This was not something I anticipated. So. If a company has negative earnings and people are paying infinite for their earnings, right? Oh, Lifetime. Who knows what Lifetime is? Go ahead.
The gym?
The gym. Lifetime Fitness. Lifetime Fitness is the gym. Okay. Yeah.
Apple, Nintendo. I know a lot of kids investing. Apple, Apple.
Lululemon people are paying like
50.
McDonald's. That's like a 40.
Lifetime Fitness people are paying like 88.
Oh, the
Netflix people are paying like McDonald's 90. And Tesla people, well Tesla's crashing.
Why you have Nintendo so high?
Wait, I put Apple.
You know, I'm gonna raise my negative.
Like an answer be like 5 cents.
You don't have to put just for the numbers.
Oh wait, 33. I 33.
Tesla,
Lifetime.
Tesla, I put 10.
no, but Netflix pay a lot. Alright, I'm ready. I hope this is right. Like 42. Look at my Wait, so the lower ones are gonna be the ones that are doing well?
Lower, no, because they're paying a lower multiple. So it's a slower growth rate.
Oh, so the lower ones.
Yeah. Or no, they have a slower growth rate. Because the ones with the higher
Wait,
So, Chris, the ones that have a higher multiple rate, those are the ones that explode faster.
Yeah, you're willing to accept a lower return now, right? Remember, because they're reciprocal.
So the more future.
More about the future.
So the higher the number, the more the future.
The more growth you're buying.
Okay.
Would you say
Remember, think of it this way. Always remember, in 2021, people were paying crazy prices for Zoom, right? Really big multiples because they thought Zoom was going to grow, right? Just always remember the Zoom example.
People are paying like brand is that? Probably like Oh, people are paying that long H&M. You got an H&M. People are paying
Daniel's like a freaking armor computer.
I'm just better, guys.
Oh, how much lower means
H&M. What is this? What is that?
Well, does current. So, first of all, what is escrow?
Don't even know. Like 300.
So this is
Again, Isaac?
currently
Oh, I
what do
didn't
they
turn off.
use to
My
supply
computer
the
was gonna be older than you.
There's like glitch happens.
If I unplug it, it will die.
That's kind of
and this and what does this supply that what is this supplying?
template that the person raising money is filling out? It is. So you just apply it, and then what is the current solutions for the current software that we're creating? By the way, this looks good. The current solutions for that. Subscriber model. But the companies that sell the software that does that now, is it a subscriber model or something that you buy once? Yeah. And what's the advantage to doing it? What is the thing that you're offering that is it, what are you competing on?
I found that I'm competing price is the average annual manual cost for just an average Fortune 500 company.
Yeah.
We'll like split that in 50 charge that much. And I'll also make it 30 seconds manual.
And right now, if an AI can do it in seconds, what is the AI doing that's currently taking you 9 months? Okay, we'll come back to it.
Okay. Madison, alright, there we go. Okay, so let's look at what y'all came up with.
I came up with some pretty good ones. Some pretty cool ones.
Oh, you know what? I might not have it. There we go. Oh, sorry, I don't have it. You know what? I'm just gonna tell you the answers. And you can compare to what you wrote down.
Scroll down to see the answer.
Oh, sorry, give me one second.
Bro, what is happening?
That's how bad we pick it. That's how bad we pick it.
PG is phony.
No, sorry. This is, you know what? I kind of, okay, here, we'll do it this way. I'm gonna show you how you look this up. You go to Yahoo Finance. Might as well do this. I thought I wrote them down. I actually did, but they're gone. So let's do this. Just read off the names to me. We'll do them one by one. PG&E.
And you spelled it wrong.
No, that's the ticker.
Guys, it's very slow.
Oh, you know why? There's so many of us on it.
Okay, I'll just look at it. My Rocket League game was working pretty well. What? 18. I got 21 guys, so
I put 68.
Where's the PE? That's the PE is the multiple. Where's the
15.
15.8.
I was at 50.
Alright.
68.
15.8.
oh, I actually guessed 15.
Ultra Beauty.
Or 8-1.
Ultra Beauty's about to be
Ultra Beauty.
Here, give me another. We won't do them all because it's slow, but give me another one.
Ultra Beauty.
Tesla.
I raise my hand.
Ultra Beauty.
McDonald's.
It's 26%, guys. Ultra Beauty, actually. What?
Says what is Ultra Beauty like a really nice stuff?
That's just how much you write. 26? Wait, I was close.
26. Is that
I got
faster?
21.
Faster or slower than Chipotle?
I said 25.
Slower.
Slower because Chipotle was 33.
Number 33, okay. Give me another one.
Tesla.
Alright. Hey, who's got the high? Let me hear. Who thinks they have a high one for Tesla?
Me.
Shout it out.
123.
370.
101.
370.
Why should it be 123?
You have 370?
What?
300.
Wait, you said 370.
Does anybody want to buy Tesla stock?
You said 370.
No.
It's 386 times earnings.
Oh.
earnings yield on 370?
1.70.
What is that?
Less than 1%.
It is less than 1%. That's it. So that's good. It's about something like a third of a percent, something like that, right? Okay. So you want to do one more or
Yeah.
Lulu? Wait, what's that?
Lululemon.
Lulu. We'll do Lulu and Netflix, and we'll stop those. All right, Lulu.
77.
I put 29.
I put
77. Come on.
12.
12.
What? Bro, who just said my thing?
That's great. So 12 means that if you buy Lulu
Change.
and the multiple doesn't change, how much do you earn a year?
10%. Less than 10%.
12.
8%. If you buy Lulu stock and its earnings do not change and its multiple does not change,
That's good.
you get to earn 8%. Right?
What's Rivian?
Oh yeah.
Right? So
I have.
here we'll do another one. How about you want to do Rivian? It's not on there.
Do
We can look at
CME.
Rivian.
Do CME.
CME?
CME.
Why do you want CME?
It's
I have a lot of money in CME. Like, too much.
You know what's funny?
down.
Like,
I
thousands.
kind of like that trade.
Can we do McDonald's?
Thousands.
Yeah, we'll do it. Pete,
28.
28. So what's the earnings yield?
It was something about 28.
4%.
It's between 3 and 4. Yeah.
Who did
And
Delta?
which one?
Delta.
Delta Airlines?
Oh, Delta.
Delta Airlines. Whoa, Delta Airlines. That one. That one? Yeah. Okay. You doubled your money. Was it because the earnings grew or the multiple grew? The multiple. The earnings stayed about the same? Yeah. So that's actually, Hunter gave a really, this is a great example.
Rivian doesn't have one.
So you got it during COVID. Okay, hey, this is great. We get to do some math. Let's go. So Hunter bought Delta. Hunter bought Delta 5 years ago. Okay? He paid how much per share roughly? $35 a share. 5 years ago he paid $35 a share. Now, interesting thing is he told me, I said, what drove the stock price today is what, 60 something here?
Guys, we should.
69. Okay.
Nice.
So he bought it for 35 and went to 69. So it's perfect. It's almost like a perfect double, right? It's about 70. So I asked him, why did it go up to 70? Is it the multiple got bigger or did the earnings grow over the last 5 years? That's the first thing I want you to always think about when you look at the return on a stock. You're like, what happened? Did the earnings grow or did the multiple change? Okay? He said the earnings did not grow. They're the same. The multiple went up. Okay. Now, if a stock doubled in 5 years, what is your annualized return? Who can figure that? I'm not. Hunter probably already knows, so I'm not going to say that. Says he's committed to this thing. So stock doubled in 5 years.
20%.
So that would be if there were no compounding, right?
Oh.
Right? Because you took a simple average. You said 2 divided by 1, like it went up a whole 1 divided by 5 years. That would give you. But there's no compounding in that.
10%. 14.4.
The King Zach nailed it exactly.
What the frick, man?
Zach, how'd you figure that out?
You divide
70
by
by
5.
5.
Oh shit.
That's right. Does that make sense? That's a pretty. I mean, that's an amazing trick. You can just do that. Like you guys know how to do this now. Like you can be right away. Hey, I doubled my money in 5 years. What is that? I made 14% a year, right? I made 14% a year. What is Delta's current earnings yield?
Wait, how do you see the stocks? What is it called?
Yahoo.
This is just Yahoo Finance. Okay. What is the current earnings yield?
Hell no. Why is my Maddox, is that my actual?
Hunters are in 14% 14% a year. How much do you think you're going to earn a year if you buy the stock for a multiple of 9?
No. Put it into Google Translate and go.
Not quite.
So wait, earnings.
That it?
How much? Wait, what's that? Oh, the earnings. Wait, how much is it?
Appropriate, man.
So if you pay 9 times earnings, 9 times earnings, how much do you think you're going to earn in return in a year?
Like 10%, 11%.
11%, right? What's the reciprocal of 9?
Yeah.
Right? 11. He's earned 14% a year on it. If you buy it today, you'd expect to earn 11. But if the multiple continues to get bigger, like if next year the multiple goes from 9 to 10, okay, you're going to get a big boost to the stock, to the return. This is, again, it's like, is this starting to make sense a little bit? Yeah? Tyler, what's up?
So for Rivian, it doesn't have a PE ratio.
What happened? Why? What do you think happens?
It was so bad that it's on the line.
So,
Is it negative?
so the earnings are negative.
Oh.
That is not that rare. A company, why would you buy a stock of something that has negative earnings?
You think it's gonna make money?
Yeah. So Amazon had negative earnings for like a decade. And it's been one of the best performing stocks of the last 25 years. It had negative earnings for a long time. So it's a little, this is where this stuff gets really hard, because it's trying to understand, having to understand their business and where their growth is coming from, right? Okay, we'll go back to, we did this one, and then, this is just kind of brings these things together. It's just the point that if you buy a stock, what's driving it is, let's say you buy the stock and the growth comes in like you expected, but the multiple falls, you're not going to make as much money as the growth of the stock. In this case, right, $10 of earnings, 40% growth in earnings, so the earnings grew 40%. But if somebody, again, it's the Liam Zoe situation, somebody's willing to pay 20 times earnings, but if somebody's only willing to pay 15 times earnings, then even though you had 40% growth in your earnings, somebody's putting less multiple on it. So you end up only making 5% on this stock, even though the earnings grew by 40, because the future of the stock is in question. Okay, so this is the Zoom example. Growth contracts. Basically, you pay a lot for the earnings, and then the expectation of the future falls. Zoom example. This is everything's just rocking. Earnings goes up. You have great earnings, and the multiple expands. This is where you hit home runs. You make tons of money in these situations. Okay? And then this is interesting. It's the flip of the first example. The earnings fall, but people become more optimistic. So that can happen. What's something where that can happen is people get so scared, and it's happening right now. We have this big thing in the markets happening right now. Software companies like Salesforce and Palantir, and all these software companies are getting wrecked right now. Why? AI. Everyone's like, what's the good of this business? I could get a robot that can make me this program. They're gonna wipe these businesses off the planet, right? So what's happening is these companies' PEs, their multiples are collapsing. They're still making tons of money, but everyone says, the future doesn't look very good. So you're might be making a lot of money right now, but I don't want to pay a big multiple for this because I don't think it's going to sustain. But what might happen is maybe the earnings will fall like people expect, but people re-rate it and say, you know what? We were a bit too pessimistic. It's going to take longer for AI to disrupt all these companies. So what might happen is the earnings might fall over the next 5 years, but the multiple might go from a really low number to a higher number because people are not as pessimistic. Does that make sense? So this is the opposite situation. So all of these things can happen. So when you look at the return on a stock, return on an investment, you want to look at it and say, the earnings getting better or worse, and is the sentiment, what people are willing to pay, getting better or worse?
Can I go get a cup of water?
Yeah, of course. Alright, so we won't do this last exercise. I was just gonna ask you if anybody wants to revise their bids with all this new knowledge you have, but that's okay. And this is just a little bit of math. If you lose, this is like kind of the flip side, the risk. If you lose, let's do this. Let's make it more fun. If you lose 25% of your money, how much do you need to make it back to even?
Wait, how much did
You lost 25% of your money. How much do you need to make to get back to even?
132%.
125.
25?
If you lose 10% of your money, how much money do you need to make? So you just start at $100.
33%?
30. Okay, that's the answer to this one. If you have $100 and you lose 10% of your money, how much do you have?
That's right.
90%?
You have $90. And then how much do you have to make to get back to even?
11?
11. Okay, if you lose 50% of your money, how much do you have to make to get back to even?
75.
Wait, if you lose 25%,
You lose 100. You have to double your money. You lose half your money, you need to double it to get it back. You got 100% return to get back. Something, so can anybody kind of see a little pattern here, general pattern?
It's harder to get back.
Harder to get back. Losing money sucks,
it's not
right?
fun.
Because it's harder to get back. You are heavily,
Write that down in the
you have to
notes.
make, yeah, you can write that down, okay?
Not
So
fun to lose money.
this is
Really?
this is basically the brutal math of it. If you lose, it's like basically saying like if you lose 50%, you make 100% back. You lose 70, you lose 80, you lose 80. Well, this one's obvious, right? You lose 90% of your money. You go from $100 down to $10. Well, you got to make a 900% to get back to even, right? These almost 10 extra money, right? Or you have to 10 extra money. So this is just a curve showing you that math of.
But that curve is also on the other side.
It's what?
It's also on the other side. Correct? Correct?
No.
Oh, we're gonna learn.
No, that's why it's messed up. It's like it's very asymmetrical. Losing is way worse than winning because you now have to get your money back on a smaller pie, right? You're multiplying your percent on a smaller sum of money. All right, so there's gonna be homework. We'll talk about that. I'll just send it to your parents and they'll give it to you. And we don't have. We're basically out of time, which is yeah. So that's it. We're done.